Thank you. Okay, we are live. We'll give attendees a few minutes to get logged in and then get started. Okay. And I'll give it till 3 minutes past and then we'll start, okay? Just so that everybody gets on. Okay. All right, get started. Welcome everybody. Welcome to the speakers and to the attendees. Looks like we're on just over 120 at the minute and it's still climbing. So hopefully a few more people joining. My name is Chandan Ramalo. I'm the spokesperson for SAPVIA and the managing director of Harmattan Renewables. And so I'm going to be facilitating the session today. So please feel free to ask us questions, please participate. We've got esteemed and knowledgeable speakers, and this is the third webinar in our 7-part series that's been organized by SAPVIA and SAWEA in partnership with BEPA, the IPP Office, and REEF. The idea behind this Developing Developer series is just to support local developers to understand the process that goes into the REEP and to developing renewable energy projects. This particular session is sponsored by Standard Bank very generously, and one of our speakers is from Standard Bank. So we're looking at the financial perspective of how to make renewable energy projects bankable, how to get access to funding, and what it takes to reach financial close. All things that you will need to understand at some point when you're dealing with our favorite friends, the lenders, and their requirements for projects. So what I'm going to do is basically introduce each of the speakers just in advance of their slot rather than going through their bios all at the beginning. We'll have a Q&A session after the first 4 speakers. So please feel free to put questions in the Q&A and we'll respond to them at that point. And then we can hopefully have a lively discussion. So our first speaker is Cheryl Byrne, who's an executive for energy and infrastructure at Standard Bank. Cheryl has over 13 years of experience in the sector and has worked on numerous energy and infrastructure projects in South Africa, including across the table from me or alongside her on a lot of projects. So Cheryl has a lot of experience with the REIPP process and getting projects across the line, understanding what developers need to do and helping them, hand-holding them through what that Standard Bank needs. So she's going to just chat to us about the REIPP financial outlook, financial modeling to financial close. As I said, I'll introduce all of the other speakers as we go along, but I'll hand over to Cheryl to get started. Kim, you could put that. Fabulous. Okay.
Thanks, everyone. So I'm going to give you, from a bank perspective, what we feel is necessary for financial close and some of the timelines and process that we would follow. I'm not going to go through specifically financial terms that banks would offer, but more the process and how we see the process developing from when you initially contact the bank for funding to when we actually reach financial close. We can move on. Just briefly, who is Standard Bank? If you don't know who Standard Bank is and you're on this call, I'm very, very surprised. But Standard Bank is the largest bank by assets across Africa. So we obviously our home base is South Africa, but we also do a lot in Africa, particularly sub-Saharan Africa. In the REEP space, Standard Bank has under it 23 billion rand of funding. And in addition to that, we helped about 25 projects reach financial close. So we do know the sector quite well, and we are familiar with the program. If we could move on to the next slide. Sorry, it's disappeared on my screen.
Just jumped out of the presentation.
We can move on to slide 9 on your slides, if you don't mind. Okay, cool. Just before that, thank you. So I guess one of the key things when you look at a project reaching financial close is, I guess sometimes there's two views that you need to take into account when looking at financing. It's the sponsor's objectives and the lender's objectives. And from my perspective, if either party is too happy, someone hasn't done their job. So it's always going to be a compromise in terms of, I guess, meeting sponsors' needs, but at the same time, lenders getting the conservative package that they need in order for a project to be bankable. So what do sponsors look at? Often sponsors want to have limited recourse, so you don't want to access your balance sheet. You want it to be an off-balance sheet instrument. You want to maximize as much debt as possible. You want long tenors because that's going to bump up your equity return and match the life of the PPA. You want some flexibility in funding terms. You don't want to be locked in forever on one financial structure. So the ability to change financial structure and do refinancings later on is quite important to sponsors. And you want to achieve financial close as quickly as possible and as cheaply as possible. Now, on the lender side, it's a very different focus. So we look at very much at de-risking the project. So we'll go through later on, one of the key things you're going to do is you're going to analyze all the risks in the project and figure out who's the best person to take that risk. We want robust security packages. We want to have reserve accounts. We want financial ratios. We want to restrict dividends to ensure that money is only flowing to shareholders once the project is performing well. And we also want to be able to have rights under material contracts so that if anything goes wrong, the lenders can take over slightly and ensure that the project doesn't go under completely. That's quite important on a renewable project where you don't really have strong asset security. So if a project were to go into default, you're more going to rely on cash flows in terms of the ability to do another project rather than selling the assets because they don't have a strong resale value. So I guess part of the process of reaching financial close is balancing the different objectives of the two main parties, which is the sponsors and the lenders. If we can move on. So what is the process to financial close? What needs to be followed? From our side, we would break it up into two main buckets. The one is the structure and the bankability bucket. And this is when you've got your project, you've got some of your permits, you've got an idea of what you're looking to do. You might have a financial advisor on board, you might not. And you come to the bank to get an indication of whether they're interested in funding the project and what they would require. Typically, you would then mandate the bank as the mandated lead arranger, and we'll go through what that means later on. And then the bank will work with you to structure and ensure that the project is bankable. So in terms of bankability, we're going to review the key contract, which is your offtake contract. So in the instance of REEP, that's quite simple. You've got a standard PPA and you know that it is bankable. But in off-grid or other programs, that is not necessarily the case. And there's a lot of focus on the PPA, and that's the power purchase agreement. And sometimes what sponsors have negotiated versus what lenders require can be quite different. And so there tends to be some negotiation around that. Other key contracts, we will get into them a little bit later, is the EPC and O&M contracts, where again, sometimes there's a slight misalignment in terms of what sponsors think are bankable versus lenders. And so we will have an initial look at that. There'll also be work required on the financial model. So often your financial advisor or someone internal in the company has developed a financial model. but the best person to review and analyze that financial model is the lender. So we'd typically have a look at the model, first check that it actually meets the requirements that we would have in our term sheet. And secondly, we would look to assist with optimization. We would know where to push and where to pull. So for example, what you can do is if you see that in the first few years, your ratios are very tight, but in the back end, they are quite high, then you can do stepped pricing, or you can do a structured step swap so that you're able to lower your tariff and be more competitive, or just make the project make sense. So the bank actually is your partner in the financial model analysis, particularly in a pre-bid stage, because no bank wants to work on a project that's not going to be successful. So some sponsors like to hold on to their model quite tight, and I can understand in really competitive situations where a bank is looking at multiple projects that sponsor is competing with, but also there are some benefits to a bank looking closely at your model at that stage, because they know what can and can't be possible, and they know their product, the debt, better than anyone else in the market. What we would also do at the structure and bankability stage, if the size of the debt is too big for one lender, we would do a market sounding. And so we would go and test the market to check that there's appetite for the project. Does the financial structure that we've come up make sense, etc. And so that's part of the structure and bankability stage. And through that process, we would work with the sponsors to determine the optimal funding solution. So what the model that you send us on day one might look very different to the model that you're actually going to implement on. We would also look to identify lenders' advisors that we would need to do due diligence, and we'll get to that later, and prepare the RFP, would get you indicative term sheets, and we would begin the process depending on the location of the deal and the structure, around getting political risk insurance cover, which is often required for long tenors outside of South Africa, or export credit agency funding, which we'll touch on later. So that is mainly, I guess, the arranging function that would come early on in the project. It's the first introduction of the bank to the project, and we assist in getting it to a structure that makes sense for all parties involved. Once you get to that stage, we then get to the due diligence phase. And this is, sometimes there's incoming shareholders coming in, so they would do their own due diligence as well. But this is often primarily the lender's due diligence phase, and shareholders do sometimes want to see some of the reports that are prepared for lenders. It is something that you can ask lenders for. Some lenders have different views, but usually the technical, insurance, and model due diligence reports can be shared with sponsors on a non-reliance basis. However, the legal due diligence that is done for lenders is usually not shared with sponsors. And that is because there might be information in there that the banks don't want to get out, because it can impact our defense later on if something goes wrong legally with the project. So which advisors do we need? Sorry, we're still on the same side. We need to get technical advisors on board. So they're going to look at the technical aspects of the project. Does it stack up? Can you connect to the grid? Does the EPC and O&M make sense in terms of what's required under the grid connection and under the PPA? We need to look at environmental aspects. So Standard Bank and all the other South African banks are equator principles banks. So we need to apply certain standards, IFC standards, to make sure that the project isn't doing harm environmentally or socially. We will need to get legal advisors on board. That is usually one of the most expensive components. So they will look at regulatory, they will look at EPC, O&M, they'll draft the finance documents, etc. So they have quite a big role. They'll look at all authorizations. We also get an insurance advisor on board. So the insurance advisor has a look at the insurance package, make sure that it is appropriate for the project and that lenders' interests are noted. And then lastly, there'll also be a model audit. Usually the model audit is the last thing to be finalized, because the model changes every day up until financial close. We've discussed finance document negotiation. The only other thing to mention on this is CPs, conditions precedent. So in order to provide debt under the financing, there's a long list, usually 30 to 40 items that we need ticked off in order to advance the funding, and those are your conditions precedent. A lot of it is authorizations. It's confirming that the right signatories have signed things, that you've got resolutions in place, etc. Please don't underestimate the timeline for that process. Minimum, you want 30 days before financial close, but I would recommend at least 60 to 90 days before financial close that you start this process. Even if your finance documents aren't fully closed out, it's useful to start this process. It is very admin intensive and takes a little bit longer. If we can move on to the next slide. So this is the financing process. I have discussed it already. So this is kind of the role that the bank would play, the bankability review, the debt arranging, and then the financial close process. I'm not going to touch on this any further. I think I did it enough in the previous slide, so we can move on. So this is also just more detail on what role the bank plays. The one thing I'd like to mention on this slide in particular is that there is an efficiency and a time consideration for the number of banks that you have in a transaction. So to reduce the underwrite risk and the potential for changing in terms, you often don't want one bank, you want multiple banks. However, you could, the issue with having multiple banks is the speed and process to close, in that you have to have everyone agree up front. So you have a lot more discussion. Instead of a meeting being able to be scheduled in 1 day, you need 3 days, for example. And so there is a benefit of having one bank versus multiple banks. So you need to consider your concern around certainty of funding terms versus your concern around speed and execution. One of the other reasons why you also want multiple banks is in case one bank can't get over the line, at least you've got someone else to continue the deal with you. But you will be slower and the process will take a little bit more time. If you've got multiple lenders, so 5 or 6, you typically want to appoint someone called a coordinating bank. And what they would do is they would manage the lenders behind the scenes. Because if you've got too many banks on a call or too many banks participating, what ends up happening is often nobody puts up their hand to take the lead. And so you have to appoint a bank to take up the lead and I guess herd the cattle. So yes, I'm referring to myself as a lender, as a cow. Let's move on to the next slide. Okay. So this is just more detail in terms of the process that would be followed. I think we've covered it quite a bit. It's nicely shown in a diagram, and typically you would need 6 to 10 months to reach financial close from when you approach the bank. And that's assuming you're approaching the bank, having done your bankability and your feasibility study and being quite far advanced. Unfortunately, I have seen projects that take significantly longer than this. So I would say up to 2 years is quite common. But a very bad example is one that has been ongoing for 11 years and should hopefully close this year. But part of those delays also come from the government side, not just from the project side. And often those delays come in around CPs or around inability to agree certain positions with government. So that's where some of the main delays tend to come from in a financing structure. If we move on. Okay, thanks. Okay, so bankable is a word that is thrown about quite a bit. But what is actually meant by the word bankable? So simplistically, it's bankable if the lenders will fund it. I know that doesn't really give too much certainty because what's bankable to one lender is not necessarily going to be bankable to another lender, but it comes down to that. And I guess one of the key things is certainty of revenue, costs, and expenses. And the whole process of determining whether something is bankable is identifying the risk, the likelihood of it occurring, how to prevent it occurring, and then allocating that risk to someone. And that is, I guess, the process of bankable that you would then look at for each aspect of the project. If we can move on. Just a few more slides. Yeah. sorry, can we just click a couple more times? 2 more. Okay. So let's go to the last slide quickly. If you don't, sorry. We're running out of time, so I think these slides might be provided. So I'm just going to go quickly on funding the previous slide. Thank you. Sorry, everyone. So just want to quickly touch on the sources of liquidity for a project and the different types of debt there are out there. So one, there is commercial banks. So I'm coming from a commercial bank background. So obviously commercial banks are usually quite flexible and they are quicker to move than some of the other entities that we're going to talk about. However, commercial banks can sometimes be more expensive and they can be tenor constraints. The good news for people with South African projects is that usually there isn't an issue with getting tenor. And actually, because it's ZAR-based funding, commercial banks are attractive funders in RAND SA deals. There's also then the non-banking financial institutions. So that's your Old Mutual, your Mergence, your Sanlam, your Future Growth. And those are institutions that usually get brought into transactions behind the scenes by the commercial banks. They don't face the same capital constraints, and so they're a good source for de-risking or passing through transactions into the market so that the banks still have capacity to do new deals. So no bank is going to want to sit with 30 or 40 billion exposure to one sector, and so therefore the ability to do new deals with the same customer or the same program is maintained by distributing to the non-banking financial institutions. You also then have the development finance institutions. You have the European institutions and the SA institutions. The SA institutions would be Dbsa and IDC. They are not quite the same in terms of how they apply things as the internationals. So typically for green projects, development finance institutions are a good option. Some of them can bring in concessionary funding, but they have strict requirements that you need to meet, particularly the international DFIs. And sometimes there is a level of inflexibility there, but they are able to do things that some commercial banks are not able to do. So they do have a very valid role to play in the mix for financial close. Very briefly, export credit agency funding. So this is where you, the bank, instead of facing project risk, would face the risk of a government, such as Germany in the example of Hermes. So if you're getting your equipment from Germany, you might be able to negotiate that structure and it might be cheaper overall. Unfortunately, with where South Africa is rated at the moment, export credit agency funding is not really viable or attractive in SA deals, but it is attractive in rest of Africa deals. And then lastly, Chinese commercial banks. If you've got a lot of Chinese shareholders or equipment, it is an option, but they are struggling also with tenor, given the current rating of the SA government. So they were an attractive option, but not so much anymore. And bond markets are still being tested, and hopefully some of the refis will be placed in there. So that's just some flavor of what's out there and the different sources of funding that need to be considered when looking at your projects. I believe I'm out of time. So any burning questions, I'm happy to take at the end. And I'll hand back to Chanda to hand over to the next person.
Thank you, Cheryl. I think key things for developers to take out of it, and Cheryl often sits trying to organize the results of this, but bring the lenders in as early as possible, as she said. I think especially if you haven't gone through a financial close process, the lenders have their requirements and personality almost. So if you're bringing in multiple lenders, you need to understand what those requirements are going to be. And as she said, do not underestimate the admin related in with going through financial close, the different parties that have to provide information, what needs to be done to go through a financial close process. So you don't just have to give people contracts and then walk away from the process. And I think the earlier you bring people in, the better. Often developers think it's cheaper to not get advisors or get the lenders in from the beginning, and it ends up costing you twice as much because you have to go back and renegotiate things. So thank you, Cheryl. Cheryl mentioned as well the Development Bank. So our next speaker is Lungile Tom, who's Senior Investment Officer in Project Finance for the Development Bank of Southern Africa. She has over 15 years of professional experience as a CA, but also an MPhil in Development Finance. Is very experienced in finance and investment professional, was in the IDC, which is the other institution that Cheryl was chatting about, and also from outside of the infrastructure space with Deloitte. So Lungile is going to speak to us about the bankability of REEP projects. I will hand over to you now, Lungile.
Thank you very much, Tanda. Afternoon, everyone. As mentioned, I'll be speaking on the bankability of REEP and also just touching on other RE projects in South Africa. To start off, for those of you who don't know who the Dbsa is, the bank was founded in 1983, 100% owned by the government. And we are also accredited agency with the Global Environment Facility, as well as the Green Climate Fund. And towards the end of the presentation, you'll obtain more clarity with regards to our collaborations and our workings with the Green Climate Fund. Further on, if we can move to the next slide, just to Chanda, the next slide. Thank you. Just to understand who the Dbsa is and where we play in the infrastructure arena, we look at infrastructure development from an integrated approach, from planning to maintaining. And what we do is we play in all these areas within the integrated approach into infrastructure development. And our key clients are ordinarily from the private sector. So we do a lot of PPPs, IPPs, which are under the REEP program, private sector, and also we fund municipalities, state-owned companies, as well as sovereigns within the continent, as well as within South Africa as well. Just an overview of the sectors that we cover. For those of you who are not familiar. And then the next one is, the next slide is, it's just to provide an overview of the global plans, regional plans, as well as the national plans that we align ourselves with. In all our efforts, we have to ensure that we are aligning ourselves and supporting the region and the national government in the medium to long-term plans for the country, as well as the region and the globe as well. And then lastly, just to touch on our role with the IPP office, Dbsa was instrumental in establishing the IPP office, as well as providing the seed capital for the establishment of the IPP office. I'm sure most of you are familiar with who the IPP office is. And Dbsa essentially provides program management support to the IPP office in order for it to fulfill its mandate. And lastly, just our impact in the renewable energy procurement, power producers procurement program, is as just to look at what we've played as a funder in supporting the financing of projects within the program. The next slide, please. Dbsa has participated in funding approximately 14 projects within the round 4 of the REEP program, and in total we've funded approximately about 33 projects. And a part of this funding, important to mention, is that we've provided funding support to BE entities and local community trusts in order to enable their equity participation in the IPPs that have been that are under the REEP program. And then now just to touch on the key pertinent bankability considerations for REEP projects. Firstly, Chanda, the next slide. The next slide again, thanks. So essentially, I will touch on the key bankability considerations. I think Cheryl has provided some insights in terms of what bankability is and what it means for lenders as well. And just to unpack that further, firstly, the lenders look at the offtake agreement, and in REEP, it is quite fortunate that this offtake agreement is underpinned by the government. So that government guarantee provided on the back of that 20-year PPA provides some strength in terms of the bankability of that REEP project. Of course, we know that the primary off-taker is Eskom. And then secondly, from the debt serviceability perspective, the PPA provides certainty from a revenue perspective, predictability and stability as well, as it is aligned with a bid tariff that is escalated and agreed upfront, escalated and escalated at CPI. Also, what lenders usually require is minimum debt service cover ratios and under ratios to be complied with by the sponsors. These minimum debt service cover ratios and other ratios have to be robust in order to ensure the bankability of that project. From a technical perspective, looking at the sponsor's capability, we look at sponsors that are reputable and have a track record essentially of implementing projects of this nature. You know, the capital outlay for projects of this nature is significant. These are significant large-scale energy generation projects, and the sponsors would have to provide or show some form of experience around the globe, as well as, you know, within REEP, within the country, and also have some track record of projects that are in operation outside the country and within the country. And then fourthly, on the next slide, thank you. Next slide, please, thanks. One thing that is also key to the bankability of these projects, it was touched on earlier by Cheryl, in terms of the emphasis on EPC and O&M contractors. So these parties also need to be reputable. They need to also have a track record and also have the adequate financial and technical capability, especially on the financial side, their ability to provide the necessary security that is required to backstop their performance obligations on either the EPC contract as well as the O&M contract as well. Also, they need to have a demonstration of operating projects under the REEP or outside of the REEP as well, outside of the country. And the LTA, as mentioned in Cheryl's presentation earlier as well, is that the lender's technical advisor is quite key in providing the necessary analysis and inputs back to the lenders with regards to these contractors, as well as the next point on the technical side, how technically sound the project is and where the key risks lie with regards to the project. So the LTA is quite instrumental in providing the necessary analysis in this to enhance the bankability of a REEP project. Then from a licensing and permitting perspective, the project, of course, has to have obtained all the material permits and licenses to enable the project to reach financial close. I mean, we've seen some of these extend beyond financial close, but usually there's plausible reasons why these permits or licenses are not obtained before financial close, but lenders want all these necessary permits and licensing to be in place before financial close, especially the material permits and licensing. Also, what is key as well is that the project needs to have access to the electricity grid. So that also needs to be in place. The relevant budget quotes from Eskom needs to have been obtained, and also a consideration whether servitudes will be required for the project as well. That needs to be a consideration from a bankability perspective. And moving on to equipment suppliers, the LTA is also quite involved in this process as well as the resource risk and the project technology from a track record and proven technology perspective. The LTA is very instrumental in opining in a number of these areas. From an equipment supply perspective, again, the main components needs to be sourced from reputable manufacturers. You know, the equipment needs to be aligned with proven technologies. And from a research perspective, lenders are also instrumental in understanding the resource risk and also opining in this area with regards to the project. And I think I've mentioned the project technology needs to be proven technology. So we're all familiar now with solar PV, wind, CSP, etc. And I thought I would include, you know, and just an outlook on what the future looks like and how we've been seeing the renewable energy market move outside of the REEP space. And if you can move on to the next slide, what we've seen is the emergence of embedded generation. I'm not going to go into the description of what embedded generation is, but hopefully everyone understands what embedded generation is. And aligned with this, the Dbsa formalized and designed a program alongside, if we can move on to the next slide. Thank you. A program alongside the GCF, which I mentioned earlier is the Green Climate Fund. And what this program is targeting is to target the implementation of, you know, embedded generation projects or distributed generation projects as defined in the RRP 2019 to enable, you know, the financing of these projects, as we've seen that some of these projects have found it difficult to obtain adequate financing packages for these projects. And the biggest reason I would say is probably, you know, as a result of not being underpinned by any government or sovereign guarantee. And this program is meant to assist with catalyzing the financing of these projects and provide some sort of a blended financing mechanism or credit enhancement mechanism in order to assist the financing of these projects. So the entire program is $200 million US, and combined with the GCF and Dbsa. If you can move on to the next slide, after this slide. Next slide. Just to unpack, no, before this, sorry. Thanks. Just to unpack what the program comprises of. So it comprises of a first loss facility for projects of this nature to assist in the bankability of these projects. And also it provides a component where it can assist BE equity financing, as well as local community trust financing as well. And the next slide, please. And this is just an illustration of how this credit enhancement affects the capital structure, or rather improves the capital structure from a senior lender perspective. On the left-hand side, you see a normal typical project finance structure. And on the right-hand side is this credit enhanced structure where that subordinated debt tranche, which is in the form of the blended financing coming from the Egypt program, which is assisting the lenders, the senior lenders in actual fact, to some extent to reduce their exposure from a debt perspective to 50% as compared to the 70%. So you have a 50% is essentially first loss tranche in the structure. And moving on, just to touch on, you know, I mean, as a DFI, we have to be aware of the development impact that we play. And this also, applies to the REEP as well, and ensuring that we are supporting the government in its climate change initiatives, as well as sustainable development goals, and also just impacting on the provision of clean energy to households, and also enabling the participation of Black entrepreneurs, Black companies who are operating in the renewable energy sector. If I can move on quickly. I mean, this is just a regulatory review, but I mean, just on municipalities, I think we've seen a lot of municipalities wanting to get into the space. And I think for them, what has been welcomed is that there has been a regulation that has been promulgated quite recently. In fact, it's a regulation amending the electricity regulations on new generation capacity. And for municipalities, what this means is that they can now procure their own energy supply through, for instance, embedded generation projects. And obviously there's criteria that needs to be met within that regulation. And the one thing that that may impede or slow down the implementation of such projects for municipalities is looking at the procurement regulations with regards to municipalities, where it may be considered quite onerous for municipalities, especially looking at the municipal PPP cycle. And lastly, just looking at the eligibility criteria for the Egypt program. Next slide, please. So, I mean, what's key here is the technologies that are looked at in the renewable energy space is solar PV and onshore wind. And the eligible off-takers, we look at private sector off-takers, so that's industrial, commercial, so it's your mines, it's your heavy manufacturing companies, as well as municipalities as well. And obviously, the project needs to be backed by, you know, a legally binding PPA with take-or-pay obligations. Thank you very much.
Thank you very much, Lungile. That was really useful and interesting. I think you're going to get a lot of questions about the balance between having limited risks with regards to the developers and their experience and exposure, and how DBSA plays a role in supporting new developers coming into the space, and particularly Black developers. So when we come to Q&A, I think you're going to probably be grilled. The other thing that I think is useful and interesting for people to just take out of this is how you're looking at an expanded suite of PPAs and open to not necessarily having a full government guarantee. I don't know if anybody's asked the question, but how you are going to look at bankability of municipalities, maybe when you're in your Q&A, will be interesting to understand, but that was very useful and helpful. Thank you. We're going to move now from the debt side of the table over to the equity side. And we've got Mark van Veek, who is a project partner and head of the energy sector for Mergence Investment Managers. He's over 15 years of experience looking at projects from development finance, structured finance, involved in impact investing, which is a very new and trendy topic in general, but something that Mark has been working on for a long time in the space. And so I'm going to hand over to Mark, whose topic is going to be experiences of equity funders participating in the REEP. Mark, are you there?
I'm here. Good afternoon, Chanda. Thank you very much for the invite. I really appreciate you making time to allow for us to share our experience. And just apologies, I'm in a bit of a noisy place here, but I had to kind of make a couple of things work to be on here today. So, well, let me start off. I think many people, I'll speak about our strategy and our philosophy, but just to follow on your last point you made with regard to impact investing, I think our first position with regard to participating in the renewable energy sector was through an impact investment lens. We were attracted, or at least I was attracted, from the fact that the local community had to have ownership in the projects. There was a big component in terms of ED spend. There was also this SED requirement. There was the local procurement. It was just a phenomenal and an amazing story to be involved with. And it was surprisingly, in 2010, there seemed to have been a bit of a market failure in terms of a limited amount of capital available to support the program, especially round one. And it's against that backdrop that we kind of, put foot on the gas and tried to raise, the first, sector homogeneous renewable energy credit fund from a zero base without having to seed it with any other funds that we were managing at the time. So we studied the sector. We identified that, there's a need for capital here, and we managed to get it away. So Mergence is currently managed by 30 billion rand of assets under management. I'm responsible for approximately 3.6 billion of that, and have invested to date in the renewable energy into about 17 projects across both equity and debt in the various different phases that we'll discuss now. And so the next slide, please. So the question is always, so why is the experience important? Why is the experience of equity investors important for other stakeholders to consider? I think what we need to realize here is, as a market, is that there is a limited pool of capital, even though sometimes it does seem as though there's an endless amount of capital available for these projects. But the capital that we have, we're competing as managers, institutional fund managers, with other investment opportunities our clients can deploy the capital into. So, obviously, we're responsible mainly for managing third-party funds, and whether it be, life insurance company money or pension fund money or provident fund money. And our objective is obviously to get the highest rate of return for the lowest amount of risk, both on the equity and on the debt side. And so it's a bit of and at the same time, delivering a fantastic impact story as well. And I can see some of my colleagues in the market is on the call this morning. So I'm sure they will be able to also share their same experiences in terms of having to kind of tick all these boxes. Now, I think what we've always heard, almost from the start of this program, everybody says, come to you, say, I've got a renewable energy program, I'm preferred bidder. I've got the debt funding as equity, you're going to experience no risk. This is a riskless investment. And the next person that come and tell me that, probably got some scars to show for in terms of this not necessarily being completely a riskless sector. And so the sponsors must also, and all the other stakeholders also realize that, various different parties bring different elements to the success of the project. And obviously risk is being shared across. So I've listed the different equity investors, at the table there, you got a B equity, you got community trust, you got a sponsor equities, you got institutional equity. And I think those institutional investors could be local investors or it could be foreign investors as well. And, sometimes all of them have different stories to tell. They're in the same project. Some people might be ecstatically happy, whereas other people are licking their wounds and they're scarred for life potentially because of what potentially happened to them as being an equity investor in the project. And I'd maybe like to share some of my experiences to date. This is still a relatively new sector, and at the outset, I also want to make sure that I'm not, my objective is not to scare anybody away from investing into the sector. I'm gonna just my caution is just to say, well, this is a specialized sector. It's important that the different parties that consider investing into the sector apply themselves appropriately, get the right advice, and be willing to put the hard work in making sure that they select the right investments for themselves or for their clients or for their families at the end of the day. That's other beneficiaries of these projects potentially. But it, like any other business, like any other investment, it's a business, and there's sometimes people involved in them, and you need to be, you need to be at your wits as to how you go about making asset allocation. So, and maybe as I go along through the different phases of the how I've tried to kind of set this up, I'll touch on some of the experiences of these different counterparties in the different stages. Maybe the next slide, please. Anyway, so I'm not going to kind of bore you with what we've done, but invested in 650 megawatts of generation capacity across about 17 projects, and we were fortunate enough to get involved very early in round one. And also thank you to our Cheryl is on the call here, our banking partners, for actually also for training us. I'm greatly indebted to the banks for helping us as institutional investors to learn and to grow, to understand the sector, and to help us along the way to make sure that we can actually make the right calls here for our clients. So next slide, please. So this is what it looks like. The top part is smooth sailing. This is it's like money for jam. Like taking sweets from a baby. You're gonna make money multiples and multiples of it. And you set off with that. But in reality, it looks different. There's maybe at the outset you start getting some first warning signs that maybe this might be a little bit different. And then you must be able to prepare yourself to actually get involved, get stuck in, because the journey is sometimes not really what it was actually mapped out to be. But if you have the right skill and the right people around you, and you're going with the right mindset, you will also get to the finishing flag. And maybe I'll touch on some of those now as we go along. So the first part of it, the next slide, please. So the first part, I think Cheryl mentioned, it's like herding cats. So especially in the development phase, there's so many different pieces moving all over the show. You may be trying it for the first time. Even if you have an experienced team, no project is exactly the same as the previous one. So you constantly have to innovate and constantly have a discipline to actually make sure that you stay on track. So that's the first part of it. And then next slide, please, is that, obviously a number of different factors playing in a successful development. So kind of think of it like being between the rock and a hard place, because now, and I think if I think back on some of those round one developers, some of those people mortgaged their homes, and they were waiting for when is preferred bidder going to be announced, or when are we going to get to financial close, because the bank is calling, they're going to come take my house, because they spent all their money in terms of developing these projects. And also a case in point for us, obviously, is I was quite involved in supporting the smalls, the less than 5 megawatt projects, and some of those developers did actually hit the wall because of government started the program from procurement and stopped. And so there's hundreds of millions of rands of development costs lost. And so over and above the complexity is obviously government or the buyer following through on the program to give certainty to the market that that they will recover the capital or the cost that they've outlaid. Another fact is obviously there's limited sources of financing for development due to the acute, kind of specialization of developing these projects. Not many people know how to do it successfully, and the the payoff profile is slightly different for different developers. Um, and and also there's limited BE financing and the constraint of actually local content, etc., to get your project to be competitive from a tariff perspective and all the other criteria as well that needs to make it competitive. So at present, like we get involved in very late stage development. It's not really our core focus, and also the way asset managers are set up. We development in the bigger scheme of things is relatively small check that needs to be written, but the risk is so high, and sometimes our mandates preclude us from actually doing it. So we have to work quite hard to get our institutional investors, our pension funds, to also buy into the concept of including development financing as part of our investment strategy, and at least get an allocation. Yeah, I think earlier it was discussed in terms of grid code connections, and then the banking partner funding requirements. I think Cheryl mentioned like the fact of getting the bankers involved early, so you know what parameters you can work in with, and progress your projects from there to next stage. So and also within that, the banking sector has changed as well over a period of time. So maybe the next slide, please. Yeah, you can maybe get the other piece up there as well. So yeah, so this was round one for us, So when I went to market to raise the round one fund, we were able to get like funding at get returns of Java plus 400 basis points, relatively conservative gearing level 70/30, and at the same time also short tenor with a long tail attached to it. And we ran our numbers on like P90 basis as opposed to P50. So and we were privileged enough to be able to negotiate very strong covenants. That world has changed, unfortunately, for us. Well, or fortunately or unfortunately, depends on what side of the fence you're sitting on. If you're a lender, like, it's changed maybe for the worse. But if you're an equity investor, trying to protect return, like, the cost of financing is the biggest cost, element in these opportunities. So that has changed over a period of time. So next slide, please, or next section. So that is kind of like what it's changed to now. It's probably even, this is old, like maybe 2 years old. What we've seen is obviously like, margins are coming down. Well, Java in itself is down now, but, and then gearing levels are going up, and tenors are being extended. Revenue, the banks are willing to consider a little bit more aggressive revenue assumptions. They're banking solar projects on the P50 basis now. And then they're also becoming more and more, taking a better view on covenants. And I think what the life cycle you see here from a credit point of view is probably the same life cycle that is currently being experienced from the equity slide as well. So equity investors at first, probably all of them wanted 20% IRRs, with relatively conservative assumptions, et cetera, et cetera. But as the program continues and as people get more success out of it, there's more and more equity investors that can come to the table. And I think what the other component, obviously, from equity and efficiency of the market is like, because the cost of the financing is such a big component. Well, the cost of the capex, but also the cost of the financing to finance the capex is a critical component in terms of where tariffs actually end up. Yeah, it's important that we get to that as a market we get to the most efficiently structured financing. And fortunately for us, or unfortunately, the listed credit market for credit is probably the most efficient and the most liquid market. We've just got one project bond out in the market currently, the Soitec CPV1, and completely illiquid currently, not really being traded like heavily, which is not good for the future rounds. And then also, the same thing on the equity side is that you had a number of different SPACs coming to the market, whether it's the Gaia or Lisani or whatever. And even those counterparties have actually struggled to maintain the interest of the big deep capital base that's in the listed market to sustain them. So and whenever you go into the private market, there's always additional credit, there's always additional margin that needs to be added to return, and ultimately, like sponsors and end consumers of energy or the country pays as a result of that inefficient market. But and I think, you know, the market is aware of it and obviously constantly working towards actually improving that. So if I go further on in, like, you know, the next phase, obviously construction phase. So what we have seen and experienced in construction phase, and obviously the big risk for us here is like missing, like, you know, scheduled commercial operation dates and the penalties that we face as equity investors, and where we're not able to either declare, like, you know, or get extension from force majeure, or whether we can get extension or good claims for some of those delays back from our EPC contractors, etc. You know, that eats into the equity return relatively quickly. And I think the RMIPP program is even more punitive than the REEF program at current stages. So, and then some of the factors that play in on that is, like, you know, supply chain lead times as a result of COVID has been negatively impacted. The ability to get, you know, the right staff on site and for this period of time required, etc., also negatively impacts onto that. I think a big concern is obviously, like, you know, our construction sector has been decimated, you know, probably due to some of their own internal issues, but also probably due to external factors that impacted negatively on the feasibility and the sustainability of the sector. So what we have is a situation that I think Cheryl will probably concur that, you know, all the usual belts and braces that we normally want to see from any other project in terms of a bankable, fully wrapped EPC contractor, like, you know, kind of investment grade subcontractor and subcontractor to a subcontractor and all the warranties, etc., to be in place. Because of where the sector finds itself today, it's very difficult to actually get those counterparties. And because they're very few and far in between, all of a sudden they become price makers as opposed to price takers. And then they squeeze the margin out of projects, unfortunately. So that's one big challenge. And at this point in time, I don't know as to how, you know, the country is going to change that. I spoke about delays and the impact of delays. And then what also plays into those delays are community unrest. You know, we've seen, like, you know, projects being hijacked, or, like, you know, construction being stopped because of community issues, rightly or wrongly. It has an impact on equity, and because of the sensitivity of equity returns to a number of the, like, you know, specifically delays that is not being compensated for, really significantly impact on the equity return. And I think, you know, the local content and the lead time that comes with that as well is also a negative risk that needs to be managed. Not saying it's all bad, it's just saying, well, this is some of the experiences that we've been having. Then next slide, please. Then there are also issues during the operational phase, and like everybody pops the champagne, you know, we flick the button, like, and everything's working, electrons are flowing, and we all go back to our offices and we're waiting for the money to come, you know, for our investors to get their cash back. And then different things start popping up, you know. So, for example, like, you know, co-investor issues, like, you know, not having appropriately structured shareholders agreements, you know, or just maybe having the wrong partners with different kind of outlooks on strategy, etc. Because these are businesses, they need to work. There's people involved in them. Even though we structured them almost to run on autopilot, there's still some level of element of human involvement in them. Then we also have, you know, the big issue in terms of overestimation of resource, whether it's wind or solar, and we've obviously found this out the hard way on the wind side. And you know, if you look at the IRR sensitivity to a resource or PR factor, it can be quite significant for a very small change in any of those factors. And then you have to work very hard on the other side to kind of make sure you protect the bottom line by optimization or extracting efficiencies. We've also had a number of, like, you know, large equipment equipment failures, that's a failure itself, but also the OEMs of some of these equipment, critical equipment, actually going into bankruptcy or no longer being there to support, you know, the equipment that they've sold to us as project companies or equity investors. And then so the warranties that we thought we had, actually we can't rely on anymore. And then we have to scramble to make sure we got like, you know, 20 year space supplies of a type of panel, like, you know, sitting in a warehouse or at the harbor somewhere. And so it's a scramble. So there's work involved in making sure you protect the bottom line.
Can I give you a 2-minute warning, please, Mark?
Yeah, I'm almost finished. And then also, like we spoke about the protest and disruption, etc. Then the next slide, please. So having said all of this, you can see it's a mixed bag. You know, someone comes and says, like, you're guaranteed, like, you know, your 18 or 20% IRR. It's not always that case, you know. So that slide you see there's a couple of overs and unders, and those are based on P50 numbers. I had to block out the names. You know, I want you guys to see as to what those projects were, but and now the onus on us as managers to pick the right ones, where there'll always be overperformance, and make sure we can pick the right counterparties. And then the next slide is, like, you know, this is not me, but you know, I'm sure this is like me and some of my counterparties in the industry. Is like, you know, we were sold, like, you know, a bed of roses, and maybe when we were young and naive, but now we got to think about a lot more different things. But also, having said that, equity investors that's invested in the program and back the right managers and back the right sponsors, looking at where they could have invested their capital, they've made a great investment and are reaping the benefits of that currently. So to encourage the developers to seek out the right equity partners, and then also don't tell them it's a risk-free investment anymore, because I think we've learned now it's not. But we also wiser to actually add our sweat and skill and bring it to the table to make sure that the projects can actually work for all of us. Thank you very much.
Thank you, Mark. That was a good recap of what you need to think about and the experience that some of the players have had with investing in projects. I think some key terms to look out for, particularly in terms of not just focusing on getting through financial close, but understanding that you're building a project that needs to be constructed. There's different risks once you get to the construction phase, and then different risks when you're operating that plant over the 20-year life of the PPA, and ensuring that you have the right teams in place to manage so that you can allocate all of those risks appropriately. I think hopefully the uncertainties associated with some of the investments that you had in round one have changed. When the program first started, there was not a lot of data available in terms of how resources were going to behave, particularly for wind. That's changed over the past 10 years or so. So hopefully don't let Mark scare you too much. There are risks, but they can be managed and mitigated. We're going to now hand over to Michael Sudakasa, who's the CEO of the Africa Business Group. The company is acts as the coordinator for PFAN, which is the Private Finance Advisory Network, and Michael's the coordinator for South Africa, Lesotho, and Eswatini. He's lived, traveled, and worked in over 50 countries, including 35 in Africa. We'd like to see the list of those countries. That will be interesting. But today, Michael's going to speak to us about access to funding for Black participation in the REEP. So Michael, I'm going to hand over to you.
Thank you, and good afternoon to everyone. It's really a pleasure to introduce to some and possibly reintroduce to others, because PFAN has been active in South Africa and Southern Africa for some time. But we're really stepping up our effort. You know, if you put a subtitle to my presentation, it's really about a resource that exists to help Black project developers in South Africa. The challenge that this organization was set up, and click one more time, please, to address, and it was established by the Renewable Energy Efficiency Partnership and UNIDO, which is part of the UN family of agencies, was that there were a growing, and this is all in an effort from a global standpoint here in South Africa to support a transition from carbon-fired electrification to, again, reduce the carbon footprint in these countries and have more green and clean energy adopted. You had growing interest on the financier side in looking at projects, but they're lamenting that the packaging of those projects was poor. And you had limited understanding amongst project developers about all those risks that Mark just talked about, what it was to actually enter this, and it's a regulated sector, to understand all of that. And so PFAN's aim was really to help move the low carbon transition forward, create climate resilient businesses in developing countries. Next slide. It's a global program, I should say. All across Africa, there are institutions like ours that are playing the role of country advisors. And as a country coordinator, we actually work with advisors and coaches who are spread around the country who actually take on individual projects. And I'll talk a little bit more about how that works. Next slide. So as I said, we're a network of private sector advisors. I think the real key selling point of the program is that there is a multi-party trust fund that supports our expenses. And so we're deployed when there's a project that, and we do have a process of evaluating projects, but is one that is deemed potentially bankable, but with assistance. And so we provide that assistance at no cost to the project developer, except for a success fee. So there is a kind of a carrot for the coaches and advisors who are involved to take the project to financial close. You see across the bottom, now we have bilateral support in addition to the initial multilateral support that started the program. Next slide, please. So historically, the program has been very much focused on clean energy and access to energy projects. I know that we're talking primarily about the REEP program, but there's now an expanded support for project developers who are involved in the integration of agriculture and energy, forestry and renewable energy, and the urban development space. We've had conversations not that long ago with some of the municipalities who are looking to bring in IPPs. Water, waste, and waste to energy are now all projects that we will look at within the PFAN program. Next slide, please. And so again, this is kind of a restatement of the sectors, and we're specifically talking about renewable energy, but if you were involved in rural electrification, energy access, clean technology, energy efficiency, again, these are all projects that PFAN would look at to support the project development. Next slide, please. I think the key thing, and again, with projects that are underpinned by power purchase agreements, the risk is less on the project developer, but we will always look to make sure that the project is commercially viable, is technically viable, that there's an experienced management team. If one is looking at the REEP program, I think your role as a sponsor is as much a coordinator in knowing who to add to your team to de-risk your project, to ensure that you've got a track record that you can lean on so that your project is seen as viable by both the debt and equity players. We have within the PFAN program a growing focus on what the gender impact is of a particular project and how to ensure that women are able to play roles as project sponsors, developers, and benefit from initiatives that are supported by PFAN. We have a longstanding climate impact and that there's growth potential. In terms of the investment ask of projects that we support, and again, one would think of PFAN as subsidized corporate finance advisors, because what we do is work with project developers, but then help them identify funders who will support their project. So in some countries, PFAN has actually developed equity funds. So Zambia is one instance where we can actually take a project and take it right to a prospective investor that we're also working in. But in many instances, and South Africa is one of those, the role is really to link the project developer to funders that have an allocation that aligns with their particular project. The sweet spot has been projects between 1 to 50 million US dollars, although in some areas like climate adaptation projects, we will look at smaller projects. We'll look at greenfield and scale up projects. And again, to date, it's mostly been the clean energy projects, although we're inching towards the climate adaptation. Technology neutral, so as it relates to REEP, if you have a wind project or you have a solar project, either is fine from our vantage point. Next slide, please. Just to give you a sense of the types of projects to date that have been funded under the program, again, disproportionately greenfield and scale up, and most have been within the $1 to $5 million bracket in terms of the funding that has been unlocked due to PFAN support. Next slide, please. Again, giving you a sense of the program's track record globally. One of the things that we noted earlier in the year when we came on board as country coordinator is that from our vantage point, disproportionately projects have been executed outside of Southern Africa in other parts of the world. And so we're working hard through initiatives like this one to have PFAN known and to develop a pipeline of projects so that we can have more initiatives happening in Southern Africa. We feel particularly buoyed by the policy evolution, I'll say change, in the last few years in South Africa. And so early on, a colleague talked about embedded generation projects. We think that there's going to be a growing opportunity for those. The REEP program has, from my vantage point, significant opportunity, but as Mark pointed out, and I know in solar, which I'll just speak to, as the cost of the technology gets reduced over time with innovation, the margins are thinner. So you really do need to know what you're doing as a project developer in a solar project, and how to keep all of your costs at the places where you targeted them, or you could end up not doing as well as you thought. So it does require all of this, particularly around the grid tied space, because it's a competition. It's a reverse auction. So the government wants to get the least cost producer of the electricity, and you as a project developer are trying to make sure that you can add a margin. So it is not something to be taken lightly as a space to evolve into. And so thankfully to me, there are other prospective projects, again, with power purchase agreements that can be developed in the South African context to help one gain some experience in managing and becoming a good orchestrator of all the cats herding that's required for these projects. Next one, please. So On the PFAN website, it's and the good thing about PFAN is that you can reach out to us directly, or you can actually go to our portal, which is pfan.net, and submit a project that you have. And in that space, then there's a preliminary evaluation of the prospective merit of your project versus other projects that come in. But then a coach is assigned to you, and that coach can help work with you through the stages of your project. Next slide. And again, this is just to give a little bit of information about how to reach me. Our regional coordinator is Thavin Naidu, and we have a regional support staff who operates out of Europe. Thank you very much for listening, and we hope to hear from some of you.
Thank you, Michael. I think that's really great information for people that are looking to get into the space and might need some support with the costs of development upfront, but also, as you said, gaining experience potentially to look at the REEP as a longer term goal. So not necessarily for the next round that's coming up, but for future rounds. So initially on the program, we were going to do the Q&A next, but I think given what all of the speakers have said, I really want to get our developer spotlight to speak before the Q&A, so that you also have a chance to hear what he has to say and ask him some questions. We've got Thabiso Tenyani, who is the founder of the Phakwe Group, which is the first majority-owned, owns the first majority-owned Black IPP in the country. And Thabiso is a whirlwind who has lots of stories and battle scars about the REEP process and how to manage financing, both from debt and equity point of view. And I think it would be great if we can hear from him before jumping into the Q&A. So Thabiso, can I hand over to you so you can give a bit of a introduction to your experience and what you've seen through Phakwe.
Thank you very much, Chanda, for the opportunity. I'm seeing faces I know. I'm seeing my lenders. I've seen Cheryl there. I must say that since 2010, informed by the IRP, we had an outcome which I think the second phase of this, if there is going to be a follow-up, we need to have an open and a very clear conversation with the lenders. It is very important because as I was looking at Lungile, they're presenting and saying 31% of the projects are Black-owned. We need to drill into that. Of course, I have emerged as one of the successful Black-owned IPP that has acquired some of the other projects, but I was in round one with Metrowind, of course, backed by Standard Bank before it then syndicated that debt to other players that are now being seen as participants into this. And equity was, I was always with Old Mutual Infrastructure Fund. But we must indicate that even that round one, it has never been very, if you look at equity participants, especially for Black equity participants, they were 3%, 6%, very small, very, very, very small. And therefore then it ended up having government having an outcry because the dominance of the investors there were mainly foreign investors, and we understand that the sector was not necessarily known in South Africa. It then attracted the mainstreams, the Scatex, and a number that have entered the market. Then it never necessarily produced a locally successful IPP, except if you look at Old Mutual itself, which was taking a significant equity in some of those projects and now ending up probably being the biggest locally owned, but it never necessarily produced any Black-owned IPP of significance. We therefore then remember that PIC had at the time warehoused a lot of projects, and we therefore then entered that fray after 4 years and acquired a 39% of one of the round one projects. And recently, I finally then acquired 51%. So I'm the first Black-owned, Black-controlled, owning 90% of a project backed by, in the leadership of my senior lenders, is Cheryl herself. And thank you very much for that, because they have then begun to believe that we need to demonstrate to government that some of other now, now that I have successfully done that, I have moved into the development side. And let me raise these issues, because if we don't raise them, therefore then we're not going to have an open conversation. They may sound controversial, but those are realities. One of the things that I've seen in this presentation, we have REEP now. It's a risk mitigation. It has a 5 months financial close period. And therefore then if you are to reflect on those presentations, they are saying 6 to 10 months. So therefore then South African lenders don't want to get to the new normal that we are talking about post-COVID. The new normal requires us to respond with speed in response to the energy crisis that we are facing in South Africa, where the CEO, which is now much capable under the radar, begins then to say quite clearly, the 2,000 megawatt that is there, it's too little and too late. So therefore then, if we're looking at economical recovery in South Africa, without energy, without electricity, there is no sector that will turn. Because COVID by itself then resulted in almost more than 2 million jobs losses, companies closing down. I think the guy, my colleague there from Mergence, was indicating that a lot of companies have closed down, subcontractors and contractors. We know that the Basel REIT, all our construction, main construction and EPCs, probably there's very few surviving today, which we don't even know that they can provide parent company guarantees that the banks can accept if we are to talk bankability in that particular context. So therefore then, here is the program that is there, 2,000 megawatt. As a developer, I'm the developer of one of the only permitted gas to power project in the country. And I have received a phenomenal response from certain lenders in the country, almost all of them. But we had to then decide, as Cheryl was saying, that you can have multiple lenders on the senior side, but you then have a complexity of not being able to have the speed at which you could do then financial close. So therefore then in that regard, I then had to, because I was fortunate enough that out of the 27 projects of round 4, I was participating into 7 of those. And therefore then my experience has made me to start having very key relationships with some of these lenders and know which ones can move with speed in doing certain things. We know also that for the fact that the extension that we got, the submission for the REEP was supposed to be the 24th of November. It has to be moved to the 22nd of December, purely because the banks needed more time in order to go to their ICs just for the first round of presenting these things. But when are they going to sit and say, what does new normal mean? What does acceleration of acquiring or procuring electricity in the country going to be done? And therefore then, what we probably not thinking with all of us, IPPs, developers, and the lenders, is under the radar again says, I'm about to decommission 10,000 megawatt of coal, which is base load. But for 1 megawatt of base load, you require 3 megawatt of renewable. So what it means is we need 30,000 megawatts to plug in that particular gap. And therefore then days of having a 75 megawatt of solar being presented by a developer are gone. Because why? Let me motivate to that. We need to group developers and have them presenting a giga once. Because why will that be important? Then you can able to re-industrialize and begin to then have a bargaining chip in order to say to the panel manufacturer, come and be in Kucha in an IDZ, and therefore then produce these panels from there from a South African context. If you have access, then you can export it to anywhere in the continent. And therefore then, are we having enough developers that can be able to be grouped and be backed by the banks? Some of us, even to date, there's still uncertainty as to whether are we capable after 2010 to date, right? So we need to look at that type of engagement, because if we are not going to come up with 2 gigas, 3 gigas, 4 gigas going forward, days of 150 megawatt, 75 are gone, because you can't bargain to a point to have an EPC price that is making your tariff to be that competitive. Because one of the things that constitute a tariff is your EPC price, it's your equipment that you are bringing in, and your cost of finance. And therefore, those 3 things by the main constitute your competitiveness in the tariff. So the more you could have a bigger size, which currently, as we speak, someone is having 150, someone is having 200, someone is having. Let's sit as a country and engage with our lenders and see how can we get around that particular part. One of the requirements also in the REEF, as we begin back as 2010, there was a very good idea of having a 150 kilometer radius of communities participating in the community trust. We know that some of the IPPs were very abusing that particular system. But equally, the lenders have taken the advantage of that in giving very expensive funding to those community trusts. As a consequence, the discontent of communities is going to be a risk that South Africa is going to face up with. Because now we are in 6 years, 10 years, they have not even seen a cent after being told that they are participants and shareholders into this. We need to look into that particular matter and begin to look at how can we refinance them, or begin to say, because there are 2 controversial issues into this. Certain clauses in the facility agreement says, if after 14 years you've never been able to repay this as a community trust, therefore then those shares are going to be seized because you have pledged them. So who's going to face up with those communities? Because if those communities are majority off from a PV perspective in Upington, they're going to be up in arms in now stopping other projects going forward. So we need to look into that. And the majority of community trust funders sits between Dbsa and IDC. And those agreements are very onerous. I'm calling for our lenders in South Africa that let's mitigate this risk before it then begins to be a bigger challenge in front of us, and find solutions, because this sector, it is for our benefit, all of us as developers, IPPs, and the lenders, and even equity participants. It is of our own right. Because some of those IPPs, because they are foreign, they have then created very structures that are going to be risky for us as locals that needs to then begin to defend going forward. So it is very important that we look into that. But let's ask ourselves that if we need to accelerate the 30,000 megawatt, I mean, okay, let me not even get there. Let me just get to what is now being issued as the current determinations and concurrence. Is the 11.8 plus the 2,000, which is 13.8, right? We know for the fact that how onerous these sovereign guarantees are to the fiscals of South Africa. It was good in 2010 to protect and put these guarantees in place in order to attract and make the investment, South African investment friendly. But should we still be having 100% for sovereign guarantees? Or should we begin to then say, there are developers that has come through the stream and we are beginning to derive the comfort. Can this move to 70% now? And begin to relieve our own balance sheet of the state that we know it is now being strained by the ESCOM debt that is almost going to $500 billion. And is this program going to be successful? So we have those issues. And I think, therefore, then I have raised issues that I appeal to lenders that this bankability and going forward, if we don't engage openly, we may find ourselves now also destroying the whole sector that we have built together. That's far. Thank you.
Thank you very much, Thabiso. I think you've raised very important points that we need to discuss. And there's a lot of questions and responses to what you were saying. What we're going to do now is just go into the Q&A session. So I think if all the speakers could please put their cameras on. Ntombi Futhi Ntuli is going to moderate this session. She's the CEO of SAWEA. So I will hand over to Ntombi, and then Ntombi will also do the closing remarks after the session. So I'll let you deal with the hot seat of the questions. Ntombi.
Thank you so much, Chanda, and thanks to all the speakers. I think the presentations were very educational, and also thank you for sharing your experiences in terms of funding and financing these complicated deals of financing renewable energy projects. We've received a lot of questions in the chat and the Q&A. I've tried to group some of them. I would just like to appeal, in the interest of time, just to appeal to the speakers to be very brief when you give your answers. I will ask a group of questions, and please just take note and decide which question you think is maybe directed to you and that you are most likely to answer. So the first group of questions is really related to the issue of experience. So we have Noni Holomisa, who's asking the requirements for sponsors to be experienced and known. How does that affect new entrants? And then Anonymous is also asking experience from DBSA, where the current REEF developers born with this experience, quite tongue-in-cheek there. And then Mlingani Matuane is also asking, without precedent, how might the DFIs help to allow new or really new players to assist in the reduction of the formation of monopolies in the RE sector as a function of how technically involved the space is? And then the other question, still from Lingani, is how do you balance, how is the balance of youth empowerment and experience requirements as per CP realized, and not to mention the known disenfranchisement of Black people without historical capital to demonstrate their skin in the game? And then maybe more directly to Lungile is a question of, will the DBSA provide refinancing funding for Black-owned companies interested in acquiring shareholding in the REEP operational projects? So I'll hand over to speakers, and I hope you've noted the questions and you can just jump in and answer one of those questions. Thank you. Or maybe I'll start with Lungile.
Thanks, Ntombifuthi. So I'll start with the last question with regards to refinancing. Unfortunately, in terms of our mandate does not include refinancing. We do support BE financing for greenfields projects. However, from a refinancing perspective, that's specifically excluded from our mandate. And then in terms of skin in the game, so I think that's in reference to the own contribution from the shareholders. You know, in terms of the BE shareholders, I think one thing that needs to be taken into account is that the BE funding that is provided for the benefit of the BE shareholders is also a function of the cash flows that are going to be generated from the project. So that BE funding will solely rely on distributions that would be generated by the projects flowing to the shareholders, as well as the BE funding providers. Now, the sizing of this BE funding is a function of those cash flows. So if the sizing comes up to approximately, let's say, 90% of what is required, it's what is communicated by the financial models that we are working with and the cash flows that are being generated by that specific project. So in terms of that, it really is a function of the cash flows. And from a youth participation perspective, generally in terms of the ED requirements, the economic development requirements, those are ordinarily stipulated in the respective RFPs. So for that particular renewable, well, the REEP route that is currently being, the projects are participating under. And what we've seen is that in this new risk mitigation procurement program, there has been a great improvement in terms of, well, there has been an enhancement in terms of the local participation, the BE participation in those respective projects. So there has been an improvement in that regard. And in terms of experience, I think, you know, it's unfortunate that the SMALLS program that was mentioned before, the small IPP program, that the intended purpose of that program was to allow for new entrants into the sector. And obviously the projects are of a smaller size, and it allows them to partner with other technical, other partners that have the technical track record in order to enhance their own track record in the sector. But unfortunately, it hasn't gone where it was supposed to go. It has stalled. And one positive aspect is that the program has been included in the strategic integrated projects where the risk mitigation program was also included. So
Lungi, can I ask you to wrap up?
Okay. With that said, hopefully we can see this program moving forward and allowing the participation of emerging entrants in this sector. Thanks.
Thanks, Lungile. Cheryl, do you have anything to add on this first set of questions regarding barriers to entry, experience required, and difficulty to access financing from a perspective of new entrants in the market?
I would say that obviously the bankability requirements do make it tough for new entrants. However, one of the benefits of a project finance structure is that you can team up with parties. So you don't just have one big experienced developer, you have smaller developers that partner alongside them. And that is actually where government regulations and rules and programs actually help assist those parties to come alongside a bigger player and learn and become themselves in the future a bigger player, because they will gain experience along the way. I do understand that obviously there's some hindrances to raising money for some of those smaller players, and that needs to be looked at. Also on the EPC and O&M perspective, it is very important to go with someone who has experience and has the balance sheet. But again, this is where government regulations are intended to help the smaller players emerge into bigger players down the line through the need for local content, BEE requirements, etc. So I think project finance does facilitate it, but it is still tough. And I think partnerships are the key.
Thank you, Cheryl. I'm going to come back to the question about municipalities, which I think were mostly directed to Lungile and Cheryl. But for now, I want to get to Michael, because still on this particular theme of questions, the question to Michael is, do you accommodate Black developers that lack own equity contribution? If so, how do you go about doing it?
The short answer is yes, but we can only go as far as we can cluster. One of the things that Dbsa said to me resonated, and Cheryl mentioned it as well. Right now, many institutions think of, I'm going to be a project developer by myself, or me and two people. There's a need to aggregate amongst would-be Black project developers. There's no magic bullet to doing this with no money. But if you can show that you've brought together a constituency, and again, I'm hopeful that everybody is looking at Dbsa not just as a motivating speaker, but a prospective business partner. He mentioned that he was around on 7 different teams. You have to get in the game and recognize how you can work with someone that is sympathetic to what you're trying to do. So the short answer is, yes, we would talk to you, but the first step would be, because I mentioned those 6 areas that we're looking at. You have to have experience. So do you have experience? If you don't have enough experience, who else can we add to your team so that you have a bigger team? The point that was mentioned about the size of the projects. Right now, we don't have the small window. So to do these bigger projects, these are multi-million-dollar projects for both debt and investment. And so without having a strong team and experience, and I'm saying the benefit now versus 2010 was that you have people like Dbsa, and there's a few others, but Dbsa, I think, becomes the person who might help an incubation program develop for BEE developers, because he has the creditworthiness, the track record, and the ability to help you reduce some of the risk that will be spotted by your prospective investors very early on. So we need to have that. And I'm planning to reach out to him to see how one can develop that, because without that, we create this, I won't say it's an illusion, but it's out there like, yeah, this is a great opportunity, but it will not materialize.
All right, so thank you. Thank you, Michael.
Tombi?
Yes.
I think I just needed to say that for people who are starting, energy is a capital intensive sector. And if you don't get that right, it's going to be very difficult and upsteep. But to respond to Lungile in saying that why necessarily the smalls could not able to thrive, here's the example. The EPC price per megawatt is an EPC price per megawatt. That's the first thing. The second thing is, therefore, then, if you work that in, as I've said it, that the EPC price and the cost of finance makes your tariff competitive. They were now sitting at R1.05, R1.10, because they couldn't. And when we were advising, my advice to them was club and at least be 20 megawatt, 4 of you, or be 30 megawatt or 40 megawatt, so that then the banks are looking at one EPC fully wrapping everything, and therefore then it becomes easier. So those smalls won't be successful as individually 5 megawatt. they won't be successful, because then the EPC price just becomes unreasonably high and makes them not to be competitive from a tariff perspective.
You're on mute, Ntombi.
Sorry, I was saying, speaking of being competitive, there's a question from Noni Holomisa who's asking, don't you think that your suggestion to form conglomerates of large IPPs or large projects will be anti-competitive and will create gatekeepers in the market? How will we ensure that those experienced IPPs will not associate with each other, thus becoming a barrier to entry for new entrants? If you can just touch briefly on that one before I get to the next question.
Yes. I think South Africa needs to ask itself, what do they want? If we want to re-industrialize, we then need to have critical mass. And there is no, as we speak today, one person sitting with 2 giga alone. So therefore then we need to come together and agree per megawatt, how much is it going to be, and how do we do that to benefit South Africa and have more jobs? If we have 2 giga, for instance, you then can roll out 200 megawatt per year. Then you're going to have sustainable jobs for over 5 years, vis-a-vis the 18 months that you're going to have for your 75 megawatt. Let's ask ourselves as a country, what do we want?
Chanda, I'm asking one last group of questions, which I think are very important, which relates to financing of municipal projects when they're procuring with IPPs. So I've got a question from Maloba Tsetla, who's asking to Lungile, when did the Embedded Generation Investment Program mechanism begin? What does the portfolio of submissions for projects look like so far? Are we seeing a significant uptake on this? And then Lucky Masuta is saying, what is the minimum size system would Dbsa fund in megawatts? And would Dbsa provide funding for the development stage of the project, which is a very risky stage? And how would you look at bankability of municipalities, both metros and other municipalities? And what level of technical feasibility is acceptable for financing of municipalities? If you can take that one, Lungile.
Thanks, Tommy Futi. Sorry, I was just jotting down the questions. In terms of uptake of the Egypt program, we do have a few projects that we are looking at. And a lot of those projects are still at RFP stage. So we're waiting for the parties to appoint the preferred bidders in order to move forward with those projects. From a municipality side, there are a few projects as well that have been developed or are in the process of being developed by other municipalities, but I think they have a bigger problem with regards to the procurement issues that hurdles that they need to overcome. As we know that, IPPO regulations that govern municipalities, that procurement process can be quite onerous and take a while actually to get finalized. So that may impact on the ability to implement these projects timelessly as well. And I'm assuming from a minimum megawatt perspective, that's with respect to the Egypt program. So we look at 10 megawatts and above. And then in terms of the bankability of municipalities, Dbsa is in a fortunate position in that regard because part of the bank's business is financing municipalities. And this is municipalities that are metros, municipalities from even smaller towns as well. So we have great depth in understanding the bankability of municipalities, and we expect to use that knowledge when assessing the bankability of municipalities. And then with regards to project development funding, DBSA does have a project development division. It's called Project Prep division within the DBSA. And what that division does is it provides funding from a certain stage in the feasibility of projects. So unfortunately, it's not very early pre-feasibility stage. However, that can change depending on the strategic nature of that project, if it's supporting a municipality, for instance, or government. So it's really, they have their own requirements with regards to where in the stage of project development do they come in from a funding support perspective. Thanks.
Thanks. Thanks so much, Lungile. I think that clarifies really well, because we've also been wondering in terms of municipalities. The regulation is actually saying municipalities in good financial standing. And if you look at the 200 plus municipalities in the country, I'm sure you can count in less than one hand the municipalities in good financial standing. So it makes financing those projects actually really difficult. The last question with regards to municipal financing was directed to Mark, but Mark is not.
Sorry, I think Dbsa just wanted to add something there before you.
Oh yeah, Dbsa, go ahead, please.
Yes, but also supporting Lungile, we need to understand the impact of Eskom's restructuring. If it moves slowly, then and in establishing your ISMO or your system and transmission market operator, if we don't clarify the wheeling tariff, then municipalities are going to have it very difficult in that particular regard. Even the embedded projects are going to have it very difficult, because we haven't necessarily heard how Eskom wants to deal with what we could refer as wires business, which is distribution and transmission. And given that, due to their financial constraints, they have indicated that they need to spend about 23 billion, 5 billion in distribution and 18 billion in transmission in the next 3 to 5 years. And we clearly don't show as to where is that going to come from if they are still in the bailout stage as is. So I think we need to cautiously look into that. And I think the frustration thereof then was triggered by the 2014 stand, the position that the rounds were stopped in 2014 until 2018. That resulted in municipalities like Western Cape indicating that we can't be in freeze for such a long time, at a time which I think, if you may remember, that the country wanted to move to nuclear. So therefore then I think it's going to take time, but we need to try and assist the industry and the sector for its own success in the last 10 years in making sure that we make the input.
Thanks so much for that contribution, Dbsa. Like I was saying, the last question was directed to Mark, and he's not with us. And I think Cheryl may be more suitable to answer that. What do you think are the 3 largest risks for embedded generation with municipality investors, which municipalities investors may face? Can you take this, Cheryl, as our last question for the day?
Yeah, sure. So I guess in terms of funding of municipal projects, I think one of the first risks that you're going to face if you're on the equity side is MFMA. So that means although you might have a great idea and you pitch it to the municipality, they will need to go and do a tender process. So any of your ideas that you've come up with, you might not actually be the one to be awarded the project. So that's one of the things to consider. In terms of bankability, it's definitely a lot easier with the corporate, the metro municipalities. You'll likely get appetite from all sectors within the funding market for for metros. If you're not dealing with the metros, it's a lot more complicated. A lot of them rely very heavily on budgetary allocations from Treasury. And the issue is those budgetary allocations are only secure for 3 years at a time, which is the budgeting cycle. And how can we place more reliance on that budgetary allocation? So that's another issue. And then I guess a little bit is perhaps the political instability of metros. An example is Tshwane, where there's a lot of stuff going on and it starts to have a knock-on effect on the operation of the municipality, or at the very least, the perception of the municipality from the funding market. And so I think those are some of the risks that need to be looked at specifically in relation to municipalities. But again, I do think there is a lot of appetite for municipalities. One of the things that I'd be interested in knowing is how negatively they've been affected by COVID and how long it's going to take for them to recover. Because I think when people do come under financial strain, they stop paying their rates and taxes, which is a big issue for metros. I think given we're running out of time, that's enough for now.
No, thanks so much. And thanks so much, Cheryl. I would like to close the session at this stage. We aimed to finish at 4 o'clock. It is exactly 16:01. I would like to thank all the participants who have stuck around. It's been a very interesting discussion with a lot of good insight from our very experienced panel of speakers. And with that, I would like to thank each and every one of you for sharing your experiences and make sure that we educate the public of South Africa about how to be involved in the REEF program, because most of people are sitting on the outskirts and actually looking in and wondering, how do I become a part of this program? So it's really great that we get people like yourselves who are able to take their experience and actually share it with the public. I would also like to thank Standard Bank, who is our sponsor for today, for the support and making sure that we are able to provide this information to the public. I think as a closing remark from myself, I would just like to say the sessions are still continuing. We are on our 3rd installment now. We planned this as a 7-part series. And we would like to invite you to participate in all the planned series, because we are still going to talk about development and construction. We're still going to talk about socioeconomic development. We're still going to talk about operations and maintenance. And there's still a lot to learn to get you to actually understand the full scope of the renewable energy procurement and development. So on that note, I would like to thank all of you for participating, and to those who I didn't get to answer or to pose your questions, we do apologize for that. It is just a matter of we ran out of time. Thank you so much for your participation.
Thank you.
Thank you.
Thanks, everyone. Bye.
Thank you. Bye-bye.
Bye.